Okay, let me just ask you, before we start this week, are you a little bit nervous for markets? Are you a little bit concerned about a potential correction or downside that could be coming? Because let's face it, the markets on the SPY or the SPX, the headline S&P, look much different than other areas. Well, the S&P 500 value stocks have declined for 10 consecutive days, the longest losing streak in history. So there's definitely some fear heading into this week's lineup of catalysts, in which I will share them with you now. Tomorrow morning, we have New York Empire State Manufacturing Index that comes out at 8:30 in the morning. At 9:45 in the morning, you get your PMIs, your global composite, manufacturing, and services PMIs, and that's your big catalyst for Monday. On Tuesday, you have retail sales month over month expecting 0.5%. Considering this economy is really dependent on people spending money, I think that'll be important. Now, for November, I think we're going to get some pretty good numbers, okay? So I think some of the fears of a slowing economy could kind of go away with the data Monday and Tuesday. But all attention is on the Fed coming Wednesday. At 2 p.m., you will get the Fed interest rate decision. There is currently a 99% chance the Fed will be cutting rates 25 basis points on Wednesday, so that is what is going to happen. But it's really about the summary of economic projections. Fed's expected inflation over the next 2 years, the federal funds, the path of the federal funds rate, GDP, and unemployment projections. These are what the markets are going to be paying very close attention to. And here's the truth. I think the Fed is going to match markets' expectations. So the markets are expecting 3 cuts next year. I think that's what we're going to get. And I think that's what the markets are going to pay the most attention to. Now, obviously, they will also pay attention to the expected unemployment rate. That's going to be the second most important aspect. The, inflation forecast, all of that. But I don't think the Fed, again, has enough confidence to really change their expectations too much because of Trump tariff policies or this or that. They just don't know. So they want to leave their optionality open. I don't think they want to crash markets into year end before Trump takes over in the White House. So I think it's going to kind of meet expectations. And I think just meeting expectations is going to be alleviating a fear catalyst. What happens when you alleviate a fear catalyst? Kind of like CPI last week. CPI report came out. It wasn't great. It was actually pretty bad, but yet markets moved higher because the catalyst was out the way. We knew what it was, and, well, fine. It's kind of like going to the dentist, right? And, maybe you've had a bad experience before, so you're a little bit nervous going to the dentist, right? Rightfully so. I mean, yeah, me too. This tooth and this tooth are fake. I busted them out, so I have 2 fake teeth in the front. I'm terrified of the dentist. You still gotta go, and you're nervous when you're going. But afterwards, I shouldn't have been as nervous as I was. Okay, that's kind of like the data that we get these days. Markets are nervous heading into it. Afterwards, we realize it's not as bad as we thought it could have been. And markets tend to rally afterwards. So the Fed's really important on Wednesday. On Thursday, we're going to get initial jobless claims. I think this is one of the biggest data points of this week because if initial jobless claims go up again, you could start a cycle of growth fears, okay? Or a growth scare. If a growth scare comes back into markets, we have a big, big problem. You also get the final growth rate for Q3, quarter over quarter. Not expecting that's going to move too much at all, so not concerned about that. You get Philly Fed data as well as Kansas Fed data as well coming out on Thursday. On Friday, you have core PCE month over month expecting 0.2%. That would actually be a really good number if it comes in at 0.2%. Last month was 0.3%. So we could really use some good inflation data right now. PPI was hot. CPI was hot last week. So a pretty tame PCE report would be great news. We will also get personal income month over month. not really a big catalyst in my opinion, expecting 0.4%. And personal spending month over month is expected at 0.5%. Overall, I think the data is probably going to be okay this week. I am expecting a growth scare will start in Q1. But during the Christmas holiday shopping period, I'm not really expecting that growth concern. Now, beyond this week, things get really exciting. Again, after the Fed, I think you could get a relief rally of sorts. Markets might be a little bit nervous heading into the Fed. But really, after this week is over with, once we start next week on December 23rd, that's where I think markets could be a little bit more optimistic. Now, could this week be a great week for markets? Of course. I think the stage is kind of set for that. Look at CNN's Fear and Greed Index. It's at 50, right? You are not optimistic. Markets are not euphoric at all at this point. Look at the RSP. The RSP is completely broken down to its support level. This trend line here, which is also at the 50-day moving average. Like, this is not, a super euphoric or super bullish market. The RSI is at 42.2. I mean, the S&P's RSI is at 59.73, which looks a little bit better. But you're not too bullish by any stretch of the imagination. Your AI investor sentiment also came down to 43.3, so you're not overstretched there either. If you look at the percent of stocks trading above their 50-day moving average, that was down 6% on Friday, down to 53.04%. I mean, only 53% of stocks are above their 50-day moving average. That's not that good. You've seen, heading into 2024, you actually got to about 85% of stocks trading above their 50-day moving average in about a 5-week time period, right? From really November 1st into, midpoint of December, you went from 20% of stocks above their 50-day moving average, a really bad number, to 85%. Okay, that is more of a bullish, euphoric kind of market. Once you get to like 75% plus, and you're not even close to there yet. What I also find very fascinating is the VIX is at 13.81. It was down about 1% on Friday, even though the Russell was destroyed, even though the S&P was slightly red, the Dow was down 0.2%. The VIX shows no concern at all. Now, if you look at the VIX curve, it's actually pricing in more fear, more of nervousness in Q1 2025. There's not a lot of fear priced in between now and year end, which I do find fascinating. Now, if you want to pick and choose what you're paying attention to right now in markets, there is plenty of things you can point to that are really good or really bad. Here's one of them. From Jason Gopher, fewer than an average of 43% of New York Stock Exchange issues rose daily over the past 2 weeks, and less than 43% of volume flowed into those issues. But the S&P 500 is still up slightly over those 2 weeks. That's only happened 2 other times since 1962. Take a look at this. This happened right before the crash of 07-08, and this happened right before the crash of 2022. Not great signs. So if you want to pick and choose what you're looking at, there's definitely problems out there in some of the data. You could also look at the December seasonality, and really after December 15th, like this, today is December 15th, so starting off tomorrow, you tend to see the markets do very well. This is a seasonal composite of the S&P 500 from December 1st through December 31st. From 1928 until today, specifically from December 15th until the 31st, markets tend to rally about 2%. Again, historically now, from 1950 through December of 1950 through 2023 in December, you tend to actually rally in the second half of December. Like 75% of the December return comes from mid-month December. So there is a very logical argument to say after some of these catalysts this week, markets could rally quite a bit. See, and to the same point that we just made, here's a very, positive sign for markets from Jason Gofort again. It says the total return for value stocks has declined for 10 consecutive days. Since 1926, this has happened fewer than 10 times. Over the past 50 years, it has preceded double-digit one-year rallies. So in fact, value selling off for 10 consecutive days typically tends to be a good sign for markets. I mean, look at all of these green moments. They were fantastic times to be buying. So you can kind of pick and choose what you want to look at right now. And Seth Golden writes on X, the coming 3-week period is historically the absolute best performing weeks of any market cycle and period historically. Election fund flow, year-end chase, Santa Claus rally period, and the first 5 days of January known as the January effect. Oh, and if you have not seen recently, Berkshire Hathaway's cash position has just hit a new record at $325 billion. Now, part of the reason I do expect we will see a growth scare, a correction in Q1 of 2025 is because Wall Street is very bullish on our markets. This is a year-end price target map from some of your Wall Street strategists. BCA Research down here is the lowest with a price target on the S&P of 4,450. Okay, but everyone else is 6,000 to 7,100. Okay. So we're above 6,000 today, so that would be like no return at all in 2025. So that's still pretty negative. But broadly speaking, taking out the bottom two targets here, you're at between 6,300 and 7,100. Your expectations are pretty high. There's a median price target of 6,600 on our markets. So, that's not crazy, but it's still pretty bullish expectations. And if we start to get any economic data that suggests we could be going into a recession or a slower growth environment, that's where we're going to have an issue. Now, I'm also going to point out the fact that a lot of stocks have done well this year, okay? And when you head into the end of the year, a lot of your hedge funds and institutions do not want to send a big tax bill to their clients, okay? It's one of the worst things you can do is have your clients, get hit with a big tax bill. So what a lot of funds may start to do is tax loss harvest, okay? Some of that tax loss harvesting could actually come by closing out of short positions, because when you close out of short positions, you free up likely some collateral, you get some of your cash freed up, and you can use that loss on that short position to offset some of your capital gains. It would not surprise me to see a bit of a mini short squeeze in markets into year end, but I do think it will be selective. I don't think it's going to be just a broad base kind of rally or short squeeze. I think, the headline S&P, it doesn't look great. The RSP doesn't look great. You could see a lot of the concentration in small caps, and maybe value could start to pick up a bit. Those would be the areas that I would be looking to see some strength start to come in. Now, some firms on Wall Street have year-end price targets like JP Morgan and, Tom Lee's Fundstrat of 6,300 by year-end, which would be a quite aggressive rally on the S&P between now and then. That would be a rally of about 4.20%. So some people think that we could still have a very strong last couple of weeks of 2024. And again, I think that makes the most sense as long as we don't get anything dramatically different from the Fed, as long as the economic data is not really bad or anything like that, then we're just kind of coasting into year end, and people don't want to change their narratives about 2025. I mean, look at the price targets coming out from Wall Street. They are bullish. They think markets are going higher. I think you're going to have to get something very dramatic the next couple of weeks to stop that. Now, specifically for Tesla, take a listen to this. Dr. Jim Thorne, the chief market strategist at Wellington Altus, predicts Tesla could hit $700 next year. This is a firm with $40 billion under management. Wellington Altus is bullish on Tesla. Take a listen to specifically what he just said, though.
In 2025, Tesla is going to become a $2 trillion company, which takes it somewhere north of $650. Charts say we could get to 700 next year. We are so early in this theme that we still do not have a true, pure AI play. And the first AI play, and I'm not talking infrastructure, I'm talking pure implementation of AI. That's Tesla. In 2025, Tesla's
Gotta unmute the mic there. I used to talk about this all the time over the past 12 months, that we would see this ChatGPT moment for Tesla. This moment where Wall Street says, okay, enough with the semiconductor providers, right? The enablers of AI. And who's going to be the appliers of AI? Because if NVIDIA is going to be this successful, you have to have some appliers of AI also be very successful. Okay. And from this, perspective, there's really nobody that is going to be growing their top line and bottom line from AI in the way that Tesla will. Okay. Google and Microsoft and Amazon, they're bettering their bottom line a little bit because of AI. Okay. They're doing that today, but it's not going to move the needle on the top line, right? And in terms of total size of those companies, AI is going to take a very long time to become a material aspect of those businesses. Whereas in Tesla is going to dominate AI. Tesla is the number one AI stock out there on our markets. And the fact that it's, a 1.3-ish trillion company is nothing compared to what the opportunity actually is. And I think we're going to be hit by a lot of upside surprises in 2025. I think we're going to have more states that get approval for robotaxi. I think actually some robotaxi capacity could start over in China with the launch of V13, which we are expecting in the first half of 2025. If not 2025 for robotaxis in China, 2026. And I think this is going to power your longer term returns for Tesla over the next couple of years. There's a lot of people that still doubt Tesla for one reason or another. But nobody seems to doubt AI, okay? And a lot of people are still in the, who's going to win AI? A lot of people still think it's the semiconductors. It's not. Did the internet providers, did Spectrum or, Comcast win the internet race? No, they helped provide the infrastructure for the internet, but the companies that actually won that were Meta, they were Amazon, they were, right, Google, okay? The actual companies that did something with the internet, okay? So it's kind of much the same thing longer term. I think Tesla's obviously going to be very successful. And I think we're going to have a lot of upside surprises in 2025. So I think 2025 in and of itself is going to be a great year for Tesla. Now, I could logically see this week and over the next couple of weeks, Tesla stock moving higher. I could see Tesla stock over $500 per share heading into 2025. Now, here's the deal. Tesla could go through a short squeeze. Tesla is already going through a gamma squeeze. If Tesla does rally further from here into year end, great. If that's what you're looking for, fantastic. Won't argue with that. But I hope Tesla falls. Okay. I hope something is dramatically different on the summary of economic projections. I hope something goes wrong and Tesla falls so we can buy more shares. Because I think Tesla could be as high as $900+ per share next year. $700 per share? Yeah, let's talk $900 per share. That's the kind of possibility we're looking at next year. That's a double up from current prices, a little bit more than a double up. But if we could see Tesla fall to like 300 again, that would be a triple up. Okay. And that's kind of the way that I'm looking at this. You've started to already see the tide turn, you know, from Wall Street focusing less on GPU providers to focusing more on AI appliers, which is, again, number one, Tesla. I think that hype will only grow in 2025. So I want to take the opportunity, if we do get that opportunity between now and year end, to buy Tesla. I don't think that's going to happen. I think there's like a 20% chance that we could actually sell off into year end. I think there's probably an 80% chance we close above $500 per share. So I'm not super confident in that. I think a short squeeze is probably likely at this point. I think a gamma squeeze is going to continue in Tesla. But when we do get that Q1 2025 correction that I think is coming, that's when I want to buy as much Tesla stock as possible. Unfortunately, if we do rise to, let's say, 500 and we fall 20%, we're only going to fall back to about $400 per share. So we'll see. Hopefully, get a little bit more of a sell down from there. I know some people are going to say, you're bullish on Tesla. You own Tesla. I own Tesla. Why do you want to see a sell off? Because I want to buy as much as possible. Because the psychological turn or shift has already happened. Again, the shift was Wall Street focusing on GPU providers, AI enablers, to now focusing on AI appliers. And that's what is, I think, behind the move in Tesla stock more than anything else right now. Wall Street is saying, who's going to be successful in actually deploying this AI? Who's going to make money from this? And Tesla is by far the easiest company you can see this, you know, progression with, and the largest company, right? Nobody's doing anything on the public markets wise like robotaxis. There's nothing bigger than that in terms of applying AI. So let me know what you guys think about this down below in the comment section. I think this week's probably going to be a good week for Tesla. The first half of the week could be a little bit slower than the second half of the week. But I do think it sets us up for a pretty nice rally into the end of December. So let me know what you guys think about this down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.